Coming up on the program, UN pulls $100 million from emergency fund in a bid to avert farming. Ethiopia freezes assets of fund accused of backing war in Tigray. Plus, a look at what African central banks may do this month with interest rates. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. We start off with the intraday market numbers, and major markets we track here in Africa were mostly positive at intraday. The NSE seemed to be turning around the losses from this week, with the index gaining 0.8%, while South Africa's JSE index also inched 0.31% up. On the flip side, the market in Egypt is negative, dropping by 0.34%. Kenya also closed positive on Tuesday. And major markets in the Gulf region were mostly positive at intraday, except the Abu Dhabi index, which declined 0.16%. Dubai's main index rose 0.29%. Elsewhere in the region, Saudi Arabia's index advanced 0.16%, while the Qatari index added 0.36%. All right, let's move to Europe, where stocks were muted this morning as a global market rally falters following a spate of positive coronavirus vaccine news. Annette Wisbach is on the verge today and joining us from the Frankfurt, the outside of Frankfurt Stock Exchange. Annette, good afternoon. Good to see you.
Well, thank you. Good afternoon to you.
Right, you're welcome. Very nice to see you, Annette, by the way. It's been a sluggish trading day so far. What are investors waiting for, and why are they again cautious?
Well, actually, I think one has first to say that the markets have rallied quite a bit, and most likely they're headed towards the best November on record, at least when we look at the Stock 600 here in Europe. So they've done a lot in November, and that is because there was a lot of optimism surrounding the vaccine coming to the market. Just today, we heard from Pfizer-BioNTech, the German-based biotech company who has a mRNA-based vaccine available, that their efficiency has risen in the test to 95%. So another positive sign for the market that most likely will get a vaccine very soon, perhaps early next year, perhaps towards the end of this year. So that was the reason why the markets were so strong. But then economic pessimism or worries have stepped in, with the likes of ECB President Lagarde, but also Jerome Powell, the very powerful Fed president, saying that the recession can be actually quite deep again because of the second wave of corona. So I guess this is why investors are kind of treading water a little bit and waiting for more signs and more clarity how the economic recovery is actually doing, because consumer spending, for example, in the US as of yesterday was actually disappointing. So the big question is whether the consumer is holding up despite the second wave, or whether people are again starting to keep their money together because they're afraid about the economic uncertainties.
Cryptocurrency. Bitcoin again appears to be going through the roof. Why?
It's actually quite an interesting one. It went unnoticed because of all the other big market themes. So Bitcoin has surged some 75% since early October, and now is trading close to its record highs at a level last seen in December 2017. So the reason behind it is that also institutional investors are now moving into Bitcoin. Some analysts are saying that the whole corona crisis has opened their minds also that most likely we're going to see a more digitalized world, a more virtual world going forward, and to which, of course, Bitcoin also belongs. That Bitcoin is going more or less mainstream is also mirrored in the fact that PayPal, the big financial services provider, is accepting Bitcoin now as a currency, which clearly is a sign that it's getting a bit more mainstream, and that perhaps also the volatility we've seen in Bitcoin might not get back into the asset. But that remains to be seen. Some people are still very skeptical about the economic outlook for Bitcoin.
And while the world economy recovers slowly, shipping rates hit record highs as the world's biggest container shipping line reports. How is Maersk doing? And what does this mean for global trade?
Actually, Maersk today announced that they are planning on buying back 1.6 billion US dollar in their shares. Maersk this year had 3 profit hikes in a row because of the crisis. So it's a clearly beneficiary, and it seems to be kind of counterintuitive. Why should the biggest global container shipping line actually benefit from the worst economic crisis since the Second World War? But the reason is quite clear, that we had a resurgence in demand for consumer goods, especially in the United States. And for example, if you look at shipping rates between the US and China, they rose by 45% plus since July until now. And that is also the case, a little bit less pronounced for other shipping routes. So the shipping freight rates, they're at record highs. And that is because the container shipping lines have reduced a lot of capacities, and at the same time also plane capacities are at very reduced levels. And if you have reduced capacities and demand is kicking in once again, then freight rates are actually rising, and that is where Maersk and the others are very much benefiting from.
Annette, we appreciate your time. And by the way, it's so nice seeing you outside the Frankfurt Stock Exchange. Perhaps sometimes we could do this, right?
Yes, we can do that if the weather is fine.
Absolutely. All right, thank you. Enjoy the rest of the day.
Thank you. And you too.
And in Asia, markets were mixed by the close trading. Investors remain cautious despite vaccine hopes as coronavirus cases continued to surge. China's Shanghai Composite edged up 0.022% to close at 3,347 points, while the Shenzhen component fell 0.54% to 13,658.20. Hong Kong's Hang Seng Index traded 0.25% higher. In Japan, the Nikkei 225 fell 1.10% to close at 25,728.14, while the Topix dropped 0.81%. However, automakers among the country's key exports fell across the board. Mitsubishi Motor dropped almost 5%, while Honda declined 3.78%. Toyota slipped 1.61%. In South Korea, the Kospi edged up 0.26% to close at 2,545.64. Australia's S&P ASX 200 rose 0.51% to 6,531 points. And U.S. stock futures declined slightly in the morning as investors digested the recent record rally in equities. Dow futures fell 60 points. Futures for the S&P 500 and Nasdaq 100 also edged marginally lower. On Tuesday, the Dow Jones Industrial Average fell more than 167 points, dragged down by Walgreens, Home Depot, and Walmart. The S&P 500 lost 0.5%. Tuesday's session was the first time in 3 days the Dow and S&P 500 fell following their record closes on Monday. A slew of retailers report quarterly earnings are expected today, Wednesday, with Target, Lowe's, and TJX companies set to report before the opening bell. Chipmaker, Nvidia, Cooper Holdings, and L Brands reporting earnings following Wednesday's session. Okay, let's go to UK now, where Britain's inflation rate notched higher, lifted by rising clothing prices, food, and second-hand cars. Figures released by the Office for National Statistics this morning show that the Consumer Price Index rose to 0.7% in October, up from 0.5% in September. Let's get in Juliana now for intraday market update. Good afternoon, Juliana. Well, despite rising to 0.7%, UK inflation is still somewhere below the 2% target, but it's interesting to know that clothing prices overall rose by 2.8% between September and October, compared with a smaller increase of 0.9%. How so? It looks like people bought clothes more even in the pandemic?
People have been buying clothes, Chimese. I've also been buying clothes, but obviously only for work, because that appears to be the only places that people are going to at the moment, besides working from home. But the overall picture here in the UK for inflation is slow, gradual inflation, and that's completely understandable, because a lot of businesses are worried about raising prices because they don't want to deter customers who are already holding on to their purses and not wanting to spend. So I think economists were pretty pleasantly surprised at the 0.2% rise from September to October to 0.7%. As you said, it's still way short of the Bank of England's target inflation rate of 2%. Just as you said, clothing is one of the upward pressures, as well as food, furniture, furnishings, soft furnishings. A lot of people working from home still building those brilliant bookshelves for their Zoom backgrounds and making their gardens look pretty, even though we are getting into the cold winter. So fair to say that these inflation figures were better than expected this afternoon.
So how are the markets chewing the numbers?
Well, the FTSE All-Share is in negative territory at intraday. We had seen, of course, that euphoria last week where we saw triple-digit gains because of the Pfizer-BioNTech and the new Moderna vaccine. But that appears to have faded away because there's lots of focus really now on the rising rates of infections. We speak a lot about Europe, and particularly in Britain. We are actually in a second lockdown here in England, but it appears as if a lot of investors are focusing solely on what's happening in America. Earlier this week, I believe over 70,000 people were known to have been hospitalized for COVID-19, and this is the first time it's happening. So there certainly appears to be maybe not a second wave, but a third wave going on there. A lot of mood music focusing on Brexit here as well. A lot of unknowns, but the unknowns appear to be upbeat. Investors still holding on to the hope that was given by Lord David Frost, the British negotiator, who has told Prime Minister Boris Johnson that a deal will be done next week. So we're all holding and waiting and holding our breath. That has kept sterling up, which means the FTSE All-Share has been down. So at intraday, the FTSE All-Share is down 0.03%. The FTSE 100 is down by 0.12%, and the FTSE 250 is up by 0.26%. In currencies, the British pound also up on the US dollar by 0.31%, up on the euro by 0.12%, and down on the Japanese yen by 0.02%.
And in corporate news, RSA, the 300-year-old insurer that owns the More Than brand, has agreed a £7.2 billion takeover from two overseas insurers that will result in the breakup of one of the FTSE 100's oldest companies. We talked about this sometime last week, Juliana, when they pushed the plan. How much do we know about the terms of the deal?
What we know is it's been agreed. I believe, yes, we did speak about this a couple of weeks ago when it was first speculated, but it has been signed and sealed. Shareholders are happy. It sent RSA's shares up 2.8% this morning, and it's actually being split, as you said. RSA, 300-year-old insurer, is almost going to be split into two halves, and that's a Canadian insurer firm called Intact Financial Corporation and Nordic insurer called Tryg. And now RSA do lots of work in the Norwegian sector. I believe Tryg have paid £4.2 billion to overtake that side of their administration, and Intact are going to be focusing on the Canadian side and perhaps some of the work that they do in the UK, where I believe they employ over 4,000 people. It is a massive deal, £7.2 billion. Shareholders are really happy with this because they do feel as if they do want to start focusing more on specific nations rather than a broader approach, which is what RSA had been doing. Their shareholders said they are pleased in accepting the cash offer for the company, which delivers attractive, certain value for shareholders. RSA has provided peace of mind to individual and protected businesses from risks for over 300 years, and I'm confident that our business will be going pretty well under Intact and Tryg. So yes, 300 years old, really old, ancient company, but £7.2 billion worth every penny.
That's huge. All right, Juliana, continue to keep track on those developments and enjoy the rest of the day.
Thank you.
We'll take a break now, and when we come back, we'll look at what African central bankers will be doing in the next couple of weeks as they meet. Just stay with us. African central bankers are meeting in the coming week for the final time this year following aggressive interest rate cuts when coronavirus restrictions shut down output. Many analysts say they have exhausted their monetary policy options. Well, let's look at what African central bankers may do this month with interest rates. I'm being joined by a banking sector analyst and the CEO, Core Street Research and Analytics, Mr. George Bodo. He joins us from Nairobi. Thank you very much, Mr. Bodo, for joining us on the program.
Thank you.
Now, African central banks maintain that they still target inflation, but it's clear that the focus this year has shifted from firmly to growth. Some analysts expect this to continue into next year. African central bankers are meeting between now and next week. Zambia today, South Africa tomorrow, Nigeria and Ghana on Monday, and of course Kenya, November 26th. What do you see these central bankers doing?
I think that's a very, very important observation. I think I see central banks and from the major economies in the continent continuing a path of what I call underwriting the economy. And this is largely through monetary policy easing that a number of them have been on over there since the pandemic struck. And you can mention the names, you can talk about Central Bank of Nigeria, you can talk about Central Bank of Kenya, the Bank of Zambia. All the major central banks have been trying to ease money. What by easing money is to make it easy for banks to get access to this huge pool of liquidity, central bank liquidity, which is supposed to design it. The understanding is that by easing that access, then they would extend the money to the real economy, and the economy will borrow the money and pick up. But that has not happened. So essentially, governments have to continue underwriting the economy. That is what you're likely to see in those meetings over the next couple of weeks. I don't think price stability has become a mandate right now. Price stability will be strong to the window. I think the key focus now is how do we jumpstart the economy amidst this pandemic.
Then, many analysts say they have exhausted their monetary policy options and the space for formal policy rate cuts is narrowing. You don't agree with that?
No, I don't agree with that. And I think now central banks have to be quite innovative, in my view, because these are very unconventional times. The traditional mandate of central banks in this part of the world was to maintain price stability through interest rate policy. Essentially, if the money creation machine is spinning too fast, then you bring it down, you slow down by interest rates. If it's spinning too slow, then you increase that pace by interest rates. Now that is out of the window at the moment. I think that now they have to embark on how they can actually now tweak that mandate, tweak it. And I can give an example, for instance, of the Bank of Ghana or the Reserve Bank of South Africa. Some of the central banks have actually undertaken to buy government bonds. And that is very critical. Even a while back, the Central Bank of Nigeria said that they are going to buy private sector bonds, corporate bonds. And that's the kind of innovation that now is central banks being called to bypass the conventional tools that they have and introduce more innovative tools. I think now the old traditional tools cannot suffice this pandemic. They have to now innovate and bypass additional channels and see if they can jumpstart the economy on their own. Essentially, they have to take on growth as part of their mandate.
Now, considering the new tweak to the COVID-19 pandemic, the hope for a vaccine soon, even though African countries are not sure when it will get to them, how do you see most African countries navigating even in 2021, given their vulnerability and volatile commodities?
I mean, from my vantage point, I think 2021 is still a lost year for this region. And I say that because if I look at, for instance, the vaccine timelines, well, the U.S. companies, the two companies that have reported success with the vaccine trials, they're issuing timelines of end of the year for them to start rolling out the vaccine. And that means that it will take some time for vaccine to hit this continent. I'm giving it end of 2021. And that means before then, the economies in this one is continue being frozen via the current mechanisms. So for me, and also on top of that, it's 2022 is also an election year for a number of African countries, including Kenya. And that means that a year to election is always preceded by heavy and hotly electioneering activities. So it's, for a number of the key countries, it's a wasted year. Election cycles around the corner, vaccine timelines still stretch for a number of us. And I'm looking at probably 2022 as probably the recovery year. We start seeing graphs going up for some of the key economies.
All right, let's look at the two largest economies in Africa, talking about Nigeria and South Africa. South Africa, of course, the central bank is meeting on Friday, and of course on Monday we have Nigeria's central bank MPC meeting. For you, what do you expect to hear at the end of that meeting, looking inwards in what is happening in the economy?
I think they will likely still be accommodative. Given that there's some accommodating move that both South Africa and CBN have done since the year began, I still expect those central banks to be very accommodating, holding policy rates in both cases. That's my projection. And also on top of that, I should expect some additional mechanisms. And for instance, for me, for Nigeria, Central Bank of Nigeria needs to ease the CRR requirements right now. If they're really keen on that credit growth. And on top of that also, central banks like, for instance, Nigeria, Central Bank of Nigeria needs to bypass the traditional channels. They need to unveil some elements of underwriting mechanisms, for instance, increase the SME guarantee, strengthen the SME guarantee platforms, unveil some of their own version of monetary stimulus. For instance, purchases of private sector credit that can also help stimulate the economy. Others, because the key thing here is how do you stimulate both the supply side and the demand side, both sides which have collapsed technically since the pandemic struck.
All right, thank you very much for your time there, George Bodo. We appreciate it. And the United Nations plans to use $100 million from the World Body's Emergency Fund to help 7 countries try to avert famine fueled by conflict, spiraling economies, climate change, and the COVID-19 pandemic. Now, some $30 million will be spent in Yemen, $15 million each in Afghanistan and northeast Nigeria, $7 million each in South Sudan and Democratic Republic of the Congo, and $6 million in Burkina Faso. And Ethiopian authorities have frozen the bank accounts of dozens of companies linked to conglomerate run by ruling party of the dissident Tigray region. Intensifying a government campaign to gain control of the state, the Attorney General's office targeted 34 subsidiaries of the Endowment Fund for the Rehabilitation of Tigray. The fund, administered by the Tigray People's Liberation Front, controls some of Ethiopia's biggest businesses, including Sur Construction and Izana Mining Development. And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwagu.